right, today we're going to talk about taxes in the federal budget. Last time we talked about crowding out, we talked about budget balance, we talked about implicit liabilities, and many folks expressed an interest in learning more about our tax system and our federal budget in general. And so that's what this is about. So we'll talk about the different types of taxes that you pay and the difference between what's known as discretionary and non-discretionary spending, as well as different ways that you can collect taxes. And we'll talk about budget surpluses and budget deficits and why the government seems to have some difficulty with them, either maintaining a surplus or dealing with deficits. So we'll start with this concept that Oliver Wendell Holmes said, taxes are what we pay for a civilized society. That's in fact the phrase that appears above the Internal Revenue Service building in D.C. Taxes are what we pay for a civilized society. We have to pay them. We don't like to pay them. We don't want to pay a whole lot, but we do have to pay them. And then the question is, how are we going to set up that system? Within the United States, there are a number of different budget and tax issues that we deal with. We've got the individual income tax, which most people are familiar with, payroll taxes, which funds Medicare, Medicaid, Social Security, a corporate income tax, excise taxes, which are per unit taxes like sales tax or cigarette tax, gas tax. You have the estate tax, which is a relatively small portion of revenue, and customs duties, among other forms of taxes that we have. In the local area, we've got property taxes as an example of a different type of tax, meals taxes, use taxes, lots of different taxes all around. We're going to mainly focus on income taxes. And what do we get for it? We get all sorts of stuff. Schools, we get government programs, we get fire, safety, roads, you name it, and generally if it's a government program, we're paying for it in the form of taxes. When we're talking about taxes, it's based on income, and income is generally described on your W-2 form, which you would get at the end of the year, as your wages, tips, and other forms of compensation. And so that is your income, and in this case it's $6,000. And if you're filling out your 1040 EZ, you'd put it in line 1. And depending on what other types of income you might have, like interest from a stock sale or from a bank account, you might add more income. But for this case, let's just pretend it's $6,000, and that's what's known as our adjusted gross income. However, that's not what you are taxed. The government will allow you to take out deductions from your income and lower what's known as your taxable income. So your income, total income, adjusted gross income, minus deductions becomes what's known as your taxable income. So in this example, there were $5,800 worth of deductions, which left a $200 taxable income. And there are lots of reasons why they allow for deductions, and we'll read about it in an article in class. But suffice it to say that the government doesn't tax you on all of the money that you make. As a result, the income tax that you pay is not fully on all of your income. Now, when you pay your tax, there are a couple things you have to keep in mind, and that is that the government has what's known as income tax withheld. Your employer actually holds onto some of your income and pays it to the IRS on your behalf throughout the course of the year. So in this case, there were $252 that were withheld by this employee during the course of the working year. Now, there are other taxes that are withheld as well. You'll see there's a Social Security tax at $357.12 and a Medicare tax at $83.52. These are what we call payroll taxes. They fund all of those programs that we talked about, Social Security, Medicare, and Medicaid. One interesting thing to note is that these are a form of double taxation in the sense that your income does not get adjusted for the taxes that you pay on Social Security and Medicare. And so if you had no deductions and your adjusted gross income was the same as your taxable income, then you would be paying tax on the Social Security and Medicare money that had been withheld, even though you never actually had it or had an opportunity to spend it. But it is something that the government does. So in this case, this person has $252 in withholdings, and they would have to figure out how much tax they owe. Now, to figure out how much tax you owe, there's a tax table that would tell you, and in this case, somebody with an income between $200 and $225 would owe $21 in total tax. Now, how did they come up with that number? Well, there are three different possible ways they could have come up with that number depending on what type of tax system they chose to use. One type of tax system is a progressive tax system. That means that the rich pay more. You earn more, you pay a higher percentage of tax on the money you make, and that's kind of like the U.S. system. Another alternative would be a proportional tax system in which everyone pays the same percentage regardless of how much you make. So those who make more pay more, but as a percentage of total income, it's exactly the same as someone who makes less. And then the third alternative is what we call a regressive system. That's where the poor would pay a higher percentage of their income than the rich. An example is payroll taxes, because everyone pays payroll taxes up to a certain amount of income, and then that income above that limit isn't taxed. So richer people tend to pay lower percentage of their income in payroll taxes than poorer people do. And so that would be a regressive system. In the United States, we've chosen to use a progressive system that utilizes what are known as marginal tax rates. So our system uses tax rates that go up as you earn more money. And as a result, we have a progressive system. And so in 2011, these were the tax rates. The lowest income people paid 10%, and then it moves up 15, 25, and so on to the top rate. Most of our taxes are paid by the rich, and I'll show you in a second how that's possible. But in general, the marginal tax rate works like this. If you were to earn $25,000, you would pay 10% income tax on that $25,000. If you earned $50,000, you would pay 10% on the first $25,000 you earned, and then 20% on the next $25,000 you earned. And then in this very simplified example, if you earned $75,000, then you'd pay 10% on the first $25,000, 20% on the next $25,000, and 30% on the last $25,000 that you earned. And you would take those dollars and add them to get your total tax that you would owe. In today's American world, we have many more tax levels than that. We actually have 6 brackets, as you can see. And so, you know, in a more realistic world, the first $8,700 you earn are taxed at 10%. Then anything between $8,700 and $35,350 would be a tax at 15%, and so on down the line. And these tax rates can be adjusted and may very well be adjusted at the end of the year. So they are constantly in flux. But the general concept that the more you make, the higher percentage tax you pay on that additional income remains the same. When it comes to who pays taxes, the short answer is that our system is very effective as a progressive system, and the rich do pay a whole lot more in total taxes than the poor. And so if you look at the graph, you can see that the top 1% of Americans, according to data from 2009, pay almost 17% of total income tax in the United States, and that the top 10% of income earners pay 43% of total income tax, whereas the bottom 50% of wage earners, the poorest 50% of the United States, only pay 13.5% of total income tax. And in fact, there's a point at which there are people who actually not only don't pay income tax, but actually receive money from the government because they earn so little. And so the system is progressive, and it is pretty effective at being progressive. When it comes to government spending, there are 2 categories of spending once they get all this money that we need to discuss. One is called discretionary, and the other is called non-discretionary. Discretionary spending is stuff that the Congress can control. They have a choice over how much money they're going to spend from year to year, and so they can make cuts or add at their will. So the Department of Defense budget is discretionary. They don't have to have it. It doesn't have to be as large as it is today. It could be bigger, it could be smaller, and they are complete control over it. Non-discretionary spending is different. Those are budget categories the government has no control over. If people meet a certain qualification, they get paid. And the Congress has no control over who does and doesn't meet the qualifications, short of changing the qualifications. But generally speaking, if the qualifications remain the same, the government has no idea really how much they're going to have to spend from year to year. They just simply follow through on the promise that they made. And so, while you can control it over the long term, in the short run, from year to year, the government has no control over that amount of spending. And that would be anything related to Social Security, Medicare, Medicaid, food stamps, etc. If people meet the qualifications, we got to pay them. When you look at total budget for the United States, for the most part, our budget is non-discretionary. That means that the government has control over only about a third of the total budget. Out of the roughly $4 trillion that we spend, only a third of it can be controlled by Congress. The other two-thirds are already spent before they can even start making any sort of real decisions. And so if you take another look at different data, you can see that the bars in red are the non-discretionary lines, and the blue are the discretionary. And so you can see that while national defense is the #1 budget line in the federal budget, and it is the one thing that we can control, the next 3 budget line items, which are added together, add up to way more than national security, are things that are out of the control of government. And so there is sort of a challenge for the government in controlling its budget deficits, because most of the spending that goes on is stuff that they can't really do anything about. And as we look into the future, one source looked at where will our money be going by 2020, and it shows, as you can see, that for the most part, nearly all of our tax money will be consumed by non-discretionary spending in the areas of Social Security, Medicare, Medicaid, and interest on the debt. Only 8% of our total tax revenue in 2020, according to one projection, would be available for national defense, for food stamps, for national parks, for roads, for railways, for running the White House, for anything that the government does outside of Medicare, Medicaid, and Social Security. So it is kind of a concern, the way that we spend, and is something that both parties are looking at. So why is it a problem? Why is this the existence of non-discretionary spending a problem? Well, because they can't control it. And so when you're trying to manage deficits, if you're trying to manage debt and control the growth of debt, and you can't control how much you spend, you have a problem. Certainly it's a challenge. It's not insurmountable, but it is difficult. Another thing is that if the government wants to deal with deficits, they could just cut spending, but as we've talked about, that could shift aggregate demand to the left and create, instead of a slow-growing expansionary economy, you could have a recessionary economy, and that's not what they're trying to accomplish. And then you've just got politics. Politics get in the way. Telling people that you're going to cut their program doesn't make them happy. They're not interested in it. And if you have a surplus, holding on to that money also doesn't tend to work, because when people see there's extra money in the government, they usually have one of two responses. Either they want tax cuts so they can get their money back, or they now see money that they can spend on other things that they didn't have money to spend on before. So the government, which we said last time should on average have a budget, a balanced budget, meaning they should have surpluses some years and deficits the other, finds that really it's very, very easy for the government to run a deficit and virtually impossible for them to run and maintain surpluses in the way that would help them on average have a balanced budget. Certainly at the federal level that's the case. Another challenge is just the way we do our budgeting, because the federal government follows what's known as a baseline budget, which means that they take how much they spent last year and assume that it's going to grow by a certain percentage next year. And so if the budget is supposed to grow by 4%, but then they choose to only grow it by 2%, the Congress generally views that as having cut the budget, even though the total number of dollars being spent is higher. Because it's not as high as it was going to be, the Congress believes that they've cut something. So as a result, again, because of politics on both sides, you talk about cuts, and while government is still increasing, there's a feeling that government has been cut. And so even though you're cutting the budget, the deficits can still continue to climb because it's still growing, just not as fast as maybe we thought it would. So there's your crash course on government spending, on government budgeting, and on government taxation. And we'll talk more about it when we're in class. Look forward to seeing you then.